Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, we discuss investment opportunities coming out of the world's extraordinary energy transition for both retail and for institutional investors. My guest is Fairman, founder and executive chair of FTSE 250 investment manager Foresight Group, which has 266 infrastructure assets in the UK and over 400 globally. Bernard, thank you so much for joining us today. We hugely appreciate it.
Yeah, I'm delighted to be here.
Now, listen, I think we've got an awful lot to talk about today, but before we start on this, could you please just explain to me how your business works? It's got a variety of divisions. It's got infrastructure. It's got private equity. It's got a capital management business. And a lot of people may know the funds inside that part of the business. But would you mind just giving us a quick overview of how the whole thing works?
Yeah, first, a very quick thumbnail kind of history lesson. I started the business 40 years ago now. And at the time, it was a venture capital business. So in 2006-07, we were amongst the first in Europe, actually, and certainly, I think, the first in the UK, to come across and start developing a business in renewable energy infrastructure. So over the last, 17 years now, we've built our position probably as one of the biggest investors in renewable energy in Europe and Australia, with about 10 billion sterling invested in that space. The second division that you referred to, which we've also built up into one or perhaps the biggest regional private equity player in the UK, invests locally with offices right across the country. That's the second part of our business. The third one, Foresight Capital Management. A few years ago, we looked at zero pretty much interest rates. How would you make a sensible return? At the time, we probably had 35,000. We now got 40,000 private investors. And we thought to ourselves, well, look, we have 100 and some odd people investing in renewable energy, low risk, reliable returns, 5%, 6% returns. Why don't we combine that knowledge with a public markets business? And we set up now a number of OICs that invest in listed renewable energy businesses, both in the UK but also worldwide. So that was the, if you will, the third leg to the business. And all of that's grown significantly over the last, 5 years.
I'm just going to go back briefly to regional private equity, because I wrote about the sad loss of the regional/provincial stock markets across the UK, and what a sad thing it was that you could no longer raise money in Aberdeen, Dundee, Edinburgh, Leeds, York, Newcastle, etc. for local projects. But, this sounds like a perfectly reasonable replacement. Except for, of course, not listed and not with the transparency and community sharing that comes with being listed, but nonetheless, a nice sort of source of regional capital.
I think it's to the credit of the many local authority pension funds that have invested with us, that they've seen that here was a pool, a possible liquidity they could contribute to that would facilitate employment in their region. And that's what we've done. We started in Nottingham, then on to Manchester, Edinburgh, Newcastle, Leeds, Cambridge, various points, east and west of that. And it is probably the leading form of regional liquidity, if you will, for small businesses. What do you do if you're a, kind of 60-year-old and you want to retire? How do you get out? How do you get liquidity? Well, very few ways of doing it.
Well, in the old days, you used to list on AIM, right? Or list on one of the regional markets, but they don't exist anymore. And AIM is a little bit of a disaster. Anyway, I interrupted you. Sorry, that's how this podcast works. You try and say something interesting and I interrupt you and say something less interesting. Apologise.
Well, I think we're all now in a position where we've got probably the biggest investment opportunity of anybody's lifetime, namely the energy transition, which is facing us and demanding probably more capital invested per year than exists. People often ask me, well, don't you find you're in great competition with other firms to invest in this or that proposition? To which my response is what I just said, namely, no, not normally, because there are vast opportunities. Running into multiple trillions a year, according to your own Bloomberg source. And nobody at the moment is remotely putting as much money into the space as is needed.
Before we move on to the energy transition and the opportunities there, the private equity business, do you find that you are generally investing in the same kind of companies? When we talk about your private equity businesses, are we also focusing on the energy transition, or is that a much wider breadth of investment opportunity?
Energy transition will be a rare investment in private equity. It's, the full range of local businesses, and we provide their liquidity. And what we do that I think is quite interesting is we'll make an investment, we'll probably bring in a new chairman or chairwoman and improve the general management of the business. We'll run it for a few years, and then, having bought it locally, we'll sell it probably globally. And there's an arbitrage just in that. And so if you look at our exits, they tend to go to American companies or big European companies. And, you get a bump as a result of doing that, having enormously, hopefully, increased the size of the business in the meanwhile.
As a result of being involved in that business, there are two things that I would love to think that you're seeing. The first one is a manufacturing resurgence in the Midlands and the north of Britain, which we talk about so much, reshoring, etc. Is manufacturing coming home? And also the productivity uplift that, again, we talk about over and over and over about how digitalization is going to bring us a great productivity uplift, which will change the dynamics of everything from our living standards to our public fiscal profile, etc. Are you seeing signs of either of those two things inside that business?
I think if you go from private ownership, who've got limited horizons, to private equity ownership, things change for the better. We don't leverage these businesses. Don't think kind of huge buyouts with enormous borrowings. Think basically all equity of one sort or the other. And we work hard to actually improve the management, improve the way these businesses work in terms of maybe they don't even have a marketing department. Now they do. And a whole lot of other things like that. Best practice. Also, I have to say, sustainability. That's something that we're very keen on because we think it makes sense economically. But if you're saying, do I see a great improvement in productivity kind of inherently? The answer is not really. And I don't really see that nationally the framework exists to make that happen.
Okay, that wasn't the answer I was hoping for.
I'm sorry, but that's what I'm seeing.
Sustainability in itself drives profitability. That is something that a lot of people say. It's entirely unproven.
If you've got sensible governance is better for a business than one person running the business and making a whole lot of mistakes.
I think people would say that good governance is different to sustainability.
Well, sustainability means a whole load of things, doesn't it? It means sourcing materials in a more intelligent way. It means communicating with your local environment, the local community. It means a whole bunch of things. Going back to the kind of energy point, we only started investing in energy because we saw it as being a success. In other words, it would be the cheapest form of energy production, not for some kind of, quasi-religious reason, because we thought it was a great thing, because we wouldn't have been able to get investors if that had been the case.
Well, that's good, because we don't encourage religious obsession on this podcast, generally speaking. But listen, I'm interested in this and the idea that renewable energy can at some point, we'll talk about what you mean by the energy transition, it can at some point become the cheapest form of energy there is, because so far, of course, that hasn't actually happened. And in the main, so far, and certainly in the short and the medium term during the transition period, of course, the energy transition is insanely expensive, hugely, hugely expensive, moving from a very dense form of energy that is reasonably inexpensive to less dense forms of energy that the infrastructure build out to allow them to feed into the grid, etc., is very expensive. So the short to medium term comes with massive cost. And so the reassurance that longer term, this is going to be a cheaper form of energy is something that I think most of our listeners could really do with hearing.
Well, it already is in some parts of the world. If you go to southern Europe, probably even northern Spain and creeping up, solar is the cheapest form of energy production.
Does that include the cost of the grid build out to take it into people's homes? It might be the cheapest way to produce a unit of energy, but in terms of transferring that unit of energy into my oven, that's another layer of cost, right?
I think that depends country by country. If you're in the United Kingdom, for example, as we are now, much of the wind comes from a place where people don't live, namely northern Scotland. And so there you've got issues. But in some parts of the world, it isn't so much of an issue. And indeed, in some parts of the world, they're building out an infrastructure pretty much from scratch. Then it isn't an issue at all because they build appropriately.
Yes, exactly. And if you're building new where there wasn't an infrastructure already, as opposed to trying to, attach bits to an old infrastructure, it's a slightly different equation.
As a general point, solar is a semiconductor. Semiconductor costs go down in line with Moore's law, 25% every 18 months in perpetuity. When we started investing, we were paying 6 or 7 or 8 euro cents a watt. Now it's down to about 0.1, 0.2, a reduction of 90 some odd plus % in cost. Now that has an impact. And that's why our view is that solar will become the backbone energy generator of choice across the world over the next 20 or 30 or 40 years.
So it's generally superior to wind, do you think?
It has the capacity for bigger cost reductions because of the way it's constructed, yes. And also it's more modular. I mean, you can put, 20 solar panels on top of your house.
Yeah.
But you probably can't put a wind generator that's going to do anything on top of your house.
No.
And that's a good thing. Distributed energy generation is inherently a good thing.
And do we worry about China's dominance of the panel manufacture business and of the metals and minerals that go into them? Or should we just put that to one side and stop getting our knickers in a twist about it?
Yeah, I think it is what it is in terms of costs of production. I worry more about putting our whole car industry in the hands of the Chinese in terms of EVs. And I worry particularly about what that will do, for example, to the European motor industry. I mean, we employ in this country 1 million people, directly and indirectly, in the motor car manufacturing business. Now, has anybody thought what happens to that? I mean, the unions begin to think about it, but has anybody thought about what happens to that if we just obliterate that and go ahead with 2030 no new ICE cars? I mean, if they have, I've not heard it.
Well, that target's being pushed back already, isn't it?
Well, I suspect that target will be pushed back a lot further than 2035 because I think the energy transition is just that, a transition. It's not a cliff face. And if you regard it as a cliff face, you will get into deep trouble.
Yeah. Now, you operate in terms of infrastructure globally, right? But you have probably the majority of your projects are in the UK. So shall we talk about some of the most interesting things that you've got going on in the UK? Because our infrastructure build-out, or our required infrastructure build-out, if we want to get anywhere near net zero by any of the chosen dates, is huge, right?
Indeed. I mean, interesting thing, we've got a pumped hydro project in Scotland, one also in the Republic of Ireland. Here you have, if you will, a lake at the top of a hill, a lake at the bottom of the hill, and you pump between them depending on costs of electricity or prices of electricity at any given time. So it's a way, if you will, of time shifting. And it's quite rare because obviously the geography has to be right. And I think we're waiting for a CFD, a contract for difference, on that Scottish property before we can finish its construction.
What does that mean, waiting for a CFD?
Well, the government needs to provide some kind of certainty. And that is a message that generally across many of these technologies. Certainty
or subsidy?
No, just certainty. What the CFD will do, it flattens things out. You don't get big spikes. In other words, if it goes above a certain price, the government gets the proceeds. Below a certain price, it results in money coming into this investment coming into the space. Becomes more investable, if you will.
What about hydrogen? You have a few hydrogen projects on the go, right?
Yeah, I'm a huge believer in hydrogen. In fact, our view is, I was talking about solar as backbone generation. Our view is for hard to electrify places and activities, hydrogen is the solution, in a number of years' time. And it's beginning to creep in to various uses now. So yes, in fact, we're raising a hydrogen fund as I speak, one of the institutional funds we're currently raising.
Oh, really? And how will that invest? I mean, hydrogen always seems to me to be one of those things that you hear about endlessly, but you never quite gets there. You never actually see a project come to fruition. You never quite get to the end with a hydro, but you think it's close now? Sorry, with hydrogen.
Well, the point to realise about hydrogen, we've been able to make hydrogen for about 100 years. The problem hasn't been how do you make it. The problem has been how do you make it economically. And the solution to that is renewables. Because as we said earlier, or implied earlier, renewable prices go up and down And in many cases, you can have negative pricing. Now, in those kind of situations, if you attach a hydrogen facility, you end up being economic in terms of the production of green hydrogen. And I think that's the key to, the ongoing rollout. They work very well together.
Okay, so you would, for example, attach a hydrogen project to a massive wind farm in Scotland, where sometimes you get, too much wind, too much power coming out of a wind farm at any particular time. You could divert that into hydrogen production. Exactly.
Because, as I say, the issue has always been cost of production, and there's a solution to the cost of production.
Is the government, this new government, still behind what you're doing, do you think? I mean, an awful lot of the stuff that we've talked about, the regional projects, infrastructure projects, renewable energy projects, they need government support and they need government rollout behind them. And we heard a lot from this government, before they were a government, about these things. Do you feel that you're going to get what you need support-wise?
Well, if you know what the government's policy is, I'd be delighted to hear it, because I'm not quite sure. Yeah, I'm not quite sure that I'm aware of what it is. I mean, I think it's worth saying governments generally get in the way, but in this business, in the renewable business, they enormously facilitated the rollout of solar back in maybe 10 some odd years ago. And so they can be helpful. One thing, however, I think it's worth saying, in Europe, we've got a problem in the sense, I think, the Prime Minister of Italy said the other day, and I completely agree, that the US innovates, which is why so much of the investment goes there. China replicates, and Europe regulates. And I think government regulation, to go back to your point, is in danger of acting as a severe deterrent to investment in this space, and in particular to competition in this space. I mean, we've got 15, 20 people who spend their whole time dealing with production of statistics that go into a government black hole somewhere and will probably never be looked at or used for anything. But more and more regulations coming in, the EU and the UK. We raise money from investors all over the place, so we have to basically adhere to any regulation from pretty much anywhere that we might get an investor, which, in my view, as I say, is very anti-competitive, because if you haven't got real scale, you can't afford to do it, and which means you won't raise money. So that is the biggest beef I think I've got with government regulation at the minute.
Over your career, has the regulatory environment become significantly worse? I mean, I think people have complained about regulation forever, but I did speak to an outgoing CEO the other day who told me that in the beginning of his quite long career, in the early days, he'd maybe engaged with the state or with the government about anything to do with regulation or obligations to the state, etc., for maybe half a day a year. Towards the end of his career, he would be dedicating 2 days a week to engaging with the state.
When I started the business in 1984, there was essentially no regulation. All the regulations sort of came in within about 3 or 4 years, and it gradually ramped up, and it's got worse and worse ever since. I mean, as the chairman of a FTSE 250 company, we spend, I'd say 80% of our board meetings talking about governance or regulation of one sort or the other. Because the fact of the matter is, if you inadvertently are in breach of something, you're in for a world of pain. So you can't afford to do that. So you have to spend appropriate time, which means you're not spending time talking about the business and adding value. So and it's only going one way. As I say, Europe regulates, but other parts of the world don't, which is why one of the reasons Europe's not getting the investment that other parts of the world are getting.
And when you say it's only going one way, but this was recognized in Draghi's report the other day as one of the big things holding back Europe. And I think everyone recognizes this is a problem in the UK, that we are overregulated, and not only do we love a regulation, but we love to layer another regulation on top of that one, and then a little bit of gold plating on top of that one. Is there any way back?
An Argentinian approach, I suggest.
Okay, so we're moving into an environment, and I think we can both feel it happening around us, where regulation rises, taxes rises, the size of the state rises. And a report from the OBR the other day suggesting that the state by within 50 years will be making up 60% of GDP, etc. I mean, that's not really possible, is it? It's not really possible for a capitalist, democratic capitalist state to operate in that environment. So something has to break or change.
Yeah, it's not far off in France now, actually, I don't think, but because they're way ahead of that, if that's the right word. I absolutely agree. I mean, you've got. I think COVID didn't help because people expected the state to do more and more, and it's a ratchet effect. In other words, once you've got it, you can't get rid of it. So if you want to deliver what the state wants to deliver, you've got to have growth. If you haven't got growth, but you're still delivering all the benefits that the state's delivering, then you just get higher and higher taxes. And at the end of the day, the whole thing will implode on itself, and we'll be back to the IMF.
That's rather why I asked you about productivity so hopefully earlier, because the sharp rise in productivity and hence growth feels like the only way out.
Well, how will you achieve that? I know how to achieve it. A lot less regulation, lower taxation, some elements of the Laffer curve, which no one in government believes in, but we're going in exactly the opposite direction. I mean, everything's cyclical, everything will change, and in some years, the whole thing will reverse. But that's the path we're on now, as far as I can see.
And the pendulum has to swing a long way before it does. But let's go to something that I do think that the government is interested in, or certainly they appear to be engaging with lots of people I talk to on this, which is the state of the UK stock market as a whole and the falling number of companies listed and the falling liquidity inside the market, lack of IPOs, etc. That seems to be something that maybe we could do something about, and possibly the government is interested in doing something about.
Indeed. And just to kind of add to that, what we're finding, I mean, our shares probably turn over £500,000 a day or something like that. And what we're finding is that when we see one of our long-standing shareholders selling, it's usually because they've got redemptions and they have to. And that's the effect that we've seen quite a lot of in the last 2 or 3 years.
It's just a function of flows out of the UK market.
And they're continuing. I mean, week by week, day by day, but it's not surprising if you look at the performance. I mean, it's self-fulfilling to an extent, but if you look at the performance of the LSE and compare it to New York and the NASDAQ, there's no comparison. So what's the solution? I mean, probably getting pension funds one way or the other, investing far more in the UK stock market, which you could do through some kind of differential taxation or regulation. And maybe doing the same for the private investors as well. But the private investors are still alive and well in the UK. I mean, as I mentioned earlier, we've got 40,000 of them investing in our products. And they are influenced by tax, as evidenced by the take-up of venture capital trusts, also EIS to an extent. So the government can change behaviour if it decides to do so through differential taxation. Yeah,
I mean, people are very incentivized by tax rates, which seems to be something this government hasn't quite understood yet. In the private equity business, one of the great hopes for the UK market, certainly for IPOs, is that at some point the private equity sector will want to get money out and so list stocks, list companies that are held inside private equity funds. But from what you said earlier, very far from thinking, well, we're going to list this stuff when we get out, you're selling it abroad.
I think so. Yeah. I mean, I can't think of the last thing we listed. To start with, listing isn't an exit. I mean, listing is a kind of waypoint along the road to exit, but it's not an exit. Secondly, I think the minimum size goes up and up, and we're dealing at the smaller end of the scale. I mean, we're writing, I don't know, 3, 5, maximum 10 or 12 million pound checks. So we're not investing in, companies that are going to list an appropriate value to bring in proper institutional interest. So the other thing I think I'd say in that context is that the LTAFs, LTIFs, where people are trying to, provide fake liquidity for inherently illiquid investments, is something that I'm not particularly enthusiastic about. I think it's a difficult issue and one that we won't really solve until institutions start investing in the UK again.
Creating fake liquidity you mean buybacks or by forcing, what do you mean?
Effectively, I mean, I've seen it again and again. People will raise some money for for private investments, and they won't invest 30 or 40% of it in order to provide liquidity.
Oh, I see what you mean. Sorry.
Well, that is the ultimate in fake liquidity. Buybacks, I think, do have their place. I mean, we've done some buybacks over the last year or so. They do have their place when you get some kind of extreme undervaluation, but also as an expression, I think, of the management's confidence in what they're doing and belief that current share price isn't right. So we're deploying company cash to buy shares back. We bought some shares over the last year, but we by and large use them for employee ownership. I mean, there's an employee stock option scheme which we've got.
But presumably you also feel your shares are horribly undervalued at the moment.
Well, we're selling at 11 times forward. I mean, problem is at that level, you can't make acquisitions because the private market's probably selling at 15, 16 times. So that needs to right itself before we can grow by acquisition, which was probably the second intent when we listed. First one being to promote our brand and our name, and people have heard of us. Because as you get bigger, you need to go to bigger institutional investors. And if they're not heard of you, you've got a major problem when you walk through the door.
Tangent, when you're talking about the energy transition, etc., would you consider, or have you got any nuclear investments at all?
No, I mean, people have talked about small nuclear reactors.
Small modular reactors, yeah. I'm very pro those. And they feel to me like they must be the answer to everything. We don't need an energy mix. We can just have lots of those. Stick one outside every town, plug them in.
Yeah. Well, we've got pretty much every other known form of renewable, but not that. And I think that's something the government really needs to, probably in conjunction with Rolls-Royce, to lead the way on, and to construct some kind of some kind of model that others can invest in. We've kept away from that. I mean, we invest in geothermal in Holland. We invest in wind in Sweden and Finland. We invest in you name it, we invested it. But that's a market that we've kept away from for the moment.
Is there any possibility of geothermal in the UK? Have we got anywhere we could do that? We haven't, have we?
Not that I'm aware of. There are very few hotspots in Europe. Holland, near Amsterdam, being one of the main ones. I think what we've got in the UK is the opportunity for gas production. Not something that we invest in or will invest in, but as I said, if we've got an energy transition and we don't want a cliff edge and we don't want to be importing more and more from possibly hostile states under certain circumstances, then we need to increase our own energy production. And fossil fuels are an area we're transitioning from, but gas is a good transition fuel. So I'm surprised, disappointed that we're not, making more use of our own resource.
Well, I think everyone is. Do you think there's any chance at all of the UK achieving net zero by 2030, 2035, 2040, 2050?
If you look at transitions in the past, if you look at the transition from horses and carts to motor cars, if you look at any other kind of transition, it always takes a lot longer than people think. So this is a 30 to 50 year job. It's not a 3 to 5 year job, particularly not a 3 to 5 year job when no one's putting in place anything that will facilitate that, like a proper charging network, or proper kind of cognizance of what it does to the UK industry by eliminating the motor car sector. None of these things I see government thinking about or putting in place makes me more convinced that this is a long-term transition. And naturally, it feels like a long-term transition. I mean, who's going to take their wood-burning stove and throw it out and put in a heat pump before they have to? So 5, 10, 15, 20 years away, depending on individual circumstances. So it's got to be done like that, and it's got to be done for reasons of economics, not the government says you've got to do it, but I'll do it because it's cheaper. Because if it isn't, you don't want to do it, and you're going to need to be compelled one way or the other, and that is not a route down which any sensible government should want to go.
I'm going to take that as a no, Bernard.
I think that's probably a long-winded no.
All right, now, Bernard, I have to ask you to say something optimistic before we go. Can you think of anything? Yeah,
the optimistic thing, I think, is that technology improves our lives all the time. Going back to energy, I mean, my specialist subject. Fact of the matter is, if you're kind of building something, all your costs are up front. If you've got, and then you do have low running costs. And so in a future world, you can imagine, our homes are powered by solar. Our cars are powered by a hydrogen fuel cell. Our planes are hydrogen, we're not emitting much in the way of carbon. And it's all cheaper because costs have come down and down and down. And that will happen. But don't expect it to happen by 2030 or 2035.
Okay, well, we'll look forward to maybe 2060 for all this, and let's hope that the state gets behind you.
Indeed. Thank you very much.
Hang on, we haven't finished yet, Bernard. You're not going to go getting away that lightly. There's always a question at the end, and it is this. If I were to give you a choice over a 10-year period, and it doesn't matter that you're not expert in these things, over a 10-year period to either hold gold or to hold Bitcoin, which one would you choose? You're a tech guy.
Yeah,
so you may have a different answer to this than other people.
I think I'd choose gold. Gold has done over the last, other than for about the last 10 or 20 years, gold has pretty much replicated what the stock market has done, what the Dow Jones has done, to be precise. And we've seen it going up quite a lot recently. I think people inherently turn to gold when push comes to shove. I mean, you can put gold in your back pocket. You can't put Bitcoin in your back pocket.
Okay. Bernard, thank you very much.
Thank you very much. My pleasure. Thank you.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sam Asadi, production support and sound design by Blake Maples. Special thanks, of course, to Bernard Fairman.